Welcome back to Lamb's Cryptoverse. Well, I'm starting to sound like a broken record because once again, this is August 5th, and we're seeing strong economic data. So I'm going to, again, repeat myself, but I'm seeing the same things, the same trend. We had strong retail sales, durable goods, business investment, PPI, CPI, and two back-to-back very strong labor reports, strong ISM services number, and I think one more thing, consumer spending, and the related PCE, consumer price inflator. That's the one the Fed really loves. That was up nearly 70%. So all this economic data was really strong, and the labor report was really, really strong. And we're going to go to the screen here, my screen, and my job is not to read you the labor report or anything or any economic data, but to interpret it. But I'm just going to go over a few highlights. Number one is that you can see here, I'll put my mouse on it, my pointer. We're back to 2020 levels, just before the pandemic. So we've got just as many jobs as we had before the pandemic. And another thing to notice is that the government jobs have declined while other jobs have increased. But some services jobs have declined, obviously, because of COVID. People are out sick still, and some people just don't want to go back to work anymore. They want to stay at home. And some other highlights of the labor report were one, unemployment rate went down to 3.5%. That's a half-century low. We had 528,000 jobs, over 500,000 jobs created in the month of July. That's unbelievable. And wage growth was pretty high. I'm trying to remember what it was. It was about 5.6%. That's also very high. So everything's looking very inflationary. And I think the Fed's got a problem. Here's the problem. Let me just go to the next website here. This is from the CME Fed Watch tool. And here's the issue. The economy is strong and the stock market is strong. They're not helping the Fed. So the Fed has no choice but to raise interest rates. Now here's the issue. We have two issues probably. Number one, as I said, the Fed needs to raise interest rates. But two, the next meeting is in September. And three, actually, we see here that these probabilities, probability of not a 50, of a 75 basis point increase is at 70% now. If you go to this website, this web page, you can see the probability, I have my pointer here, the probability of a 75 basis point hike went from nothing basically, from 3% up to today's 70%. So there's a very high probability of the Fed raising rates sharply. But what I think is going to happen, because I mentioned this is a September meeting, I think we may get an unannounced 50 basis point or 25 basis point. No, probably 50. 25 is too low. 50 basis points by August, by next month, because September is frankly too long. And if you recall what I said earlier, the Fed took perhaps as long as 1 year to raise rates, and now the opposite's happening. They're fighting last year's battle, the last battle. And what they're doing is they've become too hawkish. So what that means is they're going to probably raise rates either 75 basis points by September, or even more likely, and it's not here in this predictor, 50 basis points by August. So what does this mean? Well, let's go to my Excel spreadsheet. I created this spreadsheet that not only shows you yields per tranche by time period, but also shows you the yield curve and the yield spread. And you can see here, got it highlighted, the 10-year minus the 2, basically they call that the 10-2s. That spread has risen from 15 basis points negative to 38 basis points. So basically that's showing that there's high probability of a recession. I've said this a million times over. And another thing I want to highlight is I was a little worried because I've been calling for a steep inversion in the yield curve. And one thing I was worried about today is a 30-year bond. The 30-year bond rate actually rose a lot today, and even a 10-year. So that worries me a bit because I was not expecting that. So that's one thing I'm not expecting. The other thing I didn't expect is I've been predicting peaking inflation by June, July. And so let's see what happens because commodity prices are declining sharply off their peak. And I'm also, like I said, predicting a sharp inversion in the yield curve. So we're seeing that with the 10-2s, but I like to see the longer term rates decline. And I'm pointing, I'm highlighting this with my pointer. You see the 30-year rates at 3.1%. I'm sorry, it's 3.072%. Let me pull this out here. That's today, 3.072 versus 3.11 on July 14th. So this is comparing the two yield curves of today, August 5th, versus July 14th. And where it's blue is where you've gotten a big change in the yield curve. You could see the current yields are lower than yields from a few weeks ago. So I think there's going to be a lot more to go. And so how does this translate to the stock market? Well, the stock's acting really strong and they want to go up, and I think they can continue rising, but I'm not sure for how long because the Fed's really very hawkish and they don't have the stock markets back. The Fed put's gone. Well, thank you for listening to Lamb's Cryptoverse and have a great weekend. And please remember to subscribe and hit the like button. Thank you.